Lat CPA firm webinar series. So benefits of apartment complex investing, I'll share disclosures first. This is educational and informative. And in short, please seek a professional. Although we try to be as accurate as possible, information could change, and we're honored to be part of your journey as well. Involving table of contents, Leticia will chime in and provide her expertise on the tax portions any time of the presentation, and then we'll have Q&A. The intention of the presentation is to share value to you as a community benefits and high-level view on acquiring apartments and just some insight. Apartments is an investing niche that's alternative that can complement your current portfolio as well. We'll go over the uniquenesses, property types, how to secure, some caveats on managing property, Q&A at the end, and some free gifts for you as a thank you. Okay. About Eagle Summit Equity, we specialize in attaining real estate for passive income. We get passive opportunities through implementing the business plan through apartment and multifamily properties. We do group investments such as syndications with community investors, partners that include general and limited partners. They combine their funds to acquire larger properties. The benefit as a passive investor is you don't need to take action such as fixing the toilet or working late evenings. We'll do the hard work through underwriting conservatively, working with property managers and asset managers, and we offer potential equity and appreciation through the sale or refinance of the property. So we want to make travel, time, and freedom for you, and looking forward to connect with you. A little bit about myself. I do specifically underwrite and work with partners. My experiences are in different industries. I'm originally from Hawaii. I lived in New Jersey and California. And along the way, I do work in the health insurance industry. I'll do underwriting and coordination for health insurance quotes. And also alongside, I do real estate investing, specifically with apartments, involving some of the portfolio, work with partners to attain properties across Phoenix, Atlanta, Houston. I was a private investor previously with other investor colleagues in Kansas and Fort Lauderdale, Florida. I do stay active and learn every day with some of the mentorship programs, clubs, and with giving back through the community as well. Okay, I'll have Leticia talk about the tax benefits.
Okay, yes. So as far as tax benefits, we've been doing a webinar series since last week. And so some of the things that are attached to real estate as far as tax benefits go, I've covered 1031 exchange. And so that's really for investors. That's a tax strategy for investors. And it allows you to defer gains, not to eliminate them, but to defer capital gains. And it's because you're going to sell a property and then within 180 days, you're going to purchase something new that is of like kind. So it's a property for a property that's similar. It's not trading real estate for stocks or real estate for a trust or something like that. It has to be one property for another. And it's similar in dollar amount as far as worth goes. And it's a similar type of property, like kind exchange. And then as far as the pass-through depreciation, and so many people don't know this unless they're familiar with accounting, that depreciation is really expensing the asset over a period of time. But because of Section 179 and bonus depreciation, and then there's regular depreciation, you're able to take different levels of depreciation at an accelerated rate because of the current laws that are in place. And there's also, we've gone over like cost segregation. Sometimes you can do a cost segregation study. You would have, this is something that you actually have to pay for, where you do a study on a building, and the IRS allows you to break that building up into pieces. So you have the building itself, the structure, then you have the appliances and equipment that are in it. And usually building depreciation is 27 years or 39 and a half. It depends, but in different circumstances, how you have to take that. But with equipment, most equipment is either 5 years or 7 years of depreciation. And so in a cost segregation, you're going to break up the building and the items that are within it into different classes of depreciation, allowing you to expense that asset down much more quickly. And that's a paper loss. That's actually not money that's leaving your bank account, right? It's just reducing the value of a building over its useful life, even if when you sell that building, the value appreciated over time instead of going down. Now, something to be aware of is when you take depreciation on a asset and then you sell that asset, that there is a recapture of that depreciation on the sale. So just be aware of that you would have to recapture that depreciation and add it back in. And so part of tax strategy and doing it properly is also looking at the long-term effects of what you want to do with something. So it's not only how does this save me money now? Is it legal? Am I applying the right principles, the right laws? But in the long run, will I have a tax nightmare later if I don't set it up right when I'm trying to exit or when I'm trying to sell or what have you? Okay, all right. And back to you, Raphael.
Thank you so much, Leticia, for your insights on the tax portion. Some investor benefits for you, whether if you're active or passive. You do have the potential for cash flow and distributions and proceeds at the sale and refinance. Going into the uniqueness of apartment complexes, what's great about this niche is you do have economies of scale. An example is, okay, you want to fix a house, but you have X amount of paint you want to purchase. If you're looking into a bigger complex or commercial property, you can potentially buy at value or discount as well. The value of the property um, could be based on net operating income versus the comparables, where at commercial, net operating income, the income after operating expenses versus residential, you have comparable sales data. We still reference neighboring properties. However, with the potential income, there's more weight on that. You can do that through adding value to increase the NOI through renovation, rehab. You're adding additional amenities such as gym, pet park, for example, parking storage. Aim for market rents would be the next one. The great thing also is income stability with more doors. You have for example, you have a home with four to five rooms, versus an apartment. You do have a little more room for stability. Okay, you have two to five vacant units in an apartment versus 2 to 5 in the home. Yeah, it does make a difference. You're able to analyze prior to the purchase. This could go both for the apartment and single family properties, but there's a high chance that if you're looking into apartment complexes, there has to be more information involving your income and expenses as well. You do have active and passive income return potential, which we'll talk about in the next slide. Okay, example passive income return. So real estate is an alternative investment niche alongside private equity, for example. It can complement and add additional diversification to your current portfolio. So this is based on Investopedia and Foo.com on the history of CDs and stock markets. You do have the return of 6 to 11% for stocks, 0.09 to 5.49%. And you can add looking into building a portfolio through apartments or other real estate. with a target return as a passive investor, um, we look at 8% minimum. Uh, there could be potential proceeds. Imagine you invest 100 per every $100, you get 1.1 times that. Sometimes I do see like 2 times of your investment. So for example, per $100, you get 200 over the lifetime, including the minimum return. And then you could have potential depreciation. The reason why I share potential, it depends on deal per deal. But if you do find a good deal for this niche, you have the target return, you have the equity multiple of your original investment, and you do have the potential depreciation. So that's some benefits as well. Okay, going into property types, um, we go from small in the residential space up to 4 units or duplex, triplex, quadplex. You can go into the commercial space where it's 5 units and above. Medium, 5 to 20, larger, 20 plus. You have different types of low rise, mid rise, high rise, depending on how many floors. And then the low rise, they have different styles, such as townhomes or row houses. They're connected to each other. Garden style, it's like a shared courtyard. You can see the middle of the courtyard. You can see other parts of the apartment, but it's either like a U shape or a circle. Okay, classes. You have class A to D. It's a mix of how old the property is and location. So urban all the way to rural. When you're looking into your properties, whether it's you're wanting to get it on your own or with some partners, there's some decision factors that you would need to look into, such as location, costs, appreciation versus cash flow. Like how long do you want to keep your property? How light or how heavy is your renovation? That will factor in the cost, involving the tenant base and crime. So if it's not your cup of tea for certain markets, or if you want to just have like an easier takeover, just light rehab. So just look into those ways of deciding. Figure out your buy box as well. Uh, how much do you want to put down? What size of property do you want to start small? Do you want to work with teams and go large? You do have a range from 200K estimate to 2 million plus, which goes into 50K to 200 plus per door. What building class do you want to go to? Class A to D. For myself and my teams, we go into classes B to C. There's room to grow and renovate. I do know colleagues that do both class A and D as well. Also, look into what kind of funds are you adding to the property. Are you looking into having extra reserves? I would definitely recommend for different costs. How much are you looking to spend for rehab as well? We're going to securing a property, just a brief overview, like structure, um, whether you're an active, passive investor, market research, finding the property, important partners, analyzing the property, and a bit of the transaction. So structure, when you want to go into securing your property, or if you're an investor investing in this, look into what we're going to start with. Either if you want to do this by yourself, are you going to partner, looking into long-term joint venture, whether it's for a specific property or project, syndication for larger properties where you do need more funds, more investors and people involved. We'll go more into that next slide. Some documents to be aware of. You have the offering memorandum. It has the property information, the offer, risk, rewards. Private placement memorandum. This is the full disclosure when you're looking into a property. So those two documents are involved with syndications. If you're looking into maybe smaller units, or depending on the deal structure, how small or large, you'll work with promissory notes. It's a promise to pay based on agreed terms as a passive investor. So for example, well, one term could be 1 or 2 years, 10% return for you. Okay, for syndication structure, I'll just go high level. Either you're a sophisticated investor or accredited investor, where it's part of SEC regulations. If you're a sophisticated investor, certain investments may be available for you, where this investment could be limited to 35 non-accredited investors. It's not publicly advertised, where you do have to have an existing relationship with the expert that is providing you the opportunity or deal. And accredited investor, you would need to check off the requirements below, a certain net worth, annual income, or if you're a professional. These are okay to publicly advertise. And there's more information on if you want to go into SEC regulations, or you can feel free to reach out to me on this. Okay, I'll go ahead, have Leticia speak a bit about what is active or passive, but in general, it's whether you're working on the property or not. Thank you.
Yes, and this was also on the tax benefit slide about being a real estate professional. So when you are when you can be considered a real estate professional in the eyes of the IRS, you can actually, the losses that happen through your real estate activities can reduce your active income. So if you have W-2 income or that sort of deal, most of the time, real estate is looked at as passive activity. All right. And so, in order to qualify for the real estate professional status, the IRS has they have certain rules that you have to meet in order to have that qualification so that you can take the losses from your real estate activities and then wash out your active income. Other than that, it goes against passive income. So passive losses can only wash out passive income, if that makes sense. The IRS kind of like classes income together, and they can only, like, I guess, interact with one another. And now when it comes to the IRS's qualifications to be considered a real estate professional, the primary one is going to be hours of activity. So in order to be designated as a real estate professional, the IRS requires that you are engaging in real estate activities for a substantial amount of time, which is 750 hours per year, which turns out to be about 14 and a half hours of real estate work each week, right? So there's 52 weeks in a year, you're doing 14 and a half hours of work each year. Total should be 750 for the year. And then your real estate activities are supposed to be your primary activities. So it should constitute the majority of the time that you're spending in comparison to other professional activities. So it's not that you can't do other professional activities, like if you have another business that you run, or if you work full time during the day and then you have real estate investments. It's just that you have to show that it is a primary activity and that you participate in it more in comparison to the other things that you do. And then there's material participation. Material participation in the eyes of the IRS just means that you are physically and genuinely involved in real estate operations. And so what activities are considered as real estate activities? That would be development and redevelopment, construction and reconstruction, acquisition of properties, converting properties, so rehabbing or renovation. And then it would be rental operations, managing the rental properties, leasing them, acting as a brokerage. All right, so those are just the general areas, and then that would fall into the real estate activities realm. All right, and so if you wanted to be a real estate professional, so the documentation and the burden of proof falls on you. So with anything with the IRS, even when the IRS sends you a penalty letter, the burden of proof is on the taxpayer. And so in order for you to make this work, if you'd like to be considered a real estate professional and you are actually primarily and materially participating in managing your real estate investment properties, what you need to do is keep a log so that if ever you're audited, you have a log that you've kept throughout the year that shows that you've done 750 hours or more. And it's not just 750 hours or more of general activity related to your properties. It should fall under the IRS's activities that they consider as real estate activities, right? So development, redevelopment, construction, reconstruction, acquisition, conversion, rental operations, rental management, leasing of your rental properties or brokerage. Um, and so the mileage log is simple. You'll see people sell it online or what have you, or they have a template, but it's actually very simple. You need to keep, it's just a simple log. You can create it in Excel and it should have the date, the real estate activity that you were doing, the total time spent doing it. So you could do start time, end time, total amount of hours for that date, and then any notes commenting on the details of the activity. I'm going to say that one more time. So the log should be simple. Don't go pay $50 for somebody's real estate professional log, okay? It's very simple, created in Excel or on Google Sheets. You should have the date, you should have the real estate activity, right? Because the IRS only counts the activities that line up with their requirements. And so the real estate activity and then the total time that you spent doing it. So that could be your start time, your end time, total amount of time, 1.5 hours, 2.5 hours for that date. All right, and then I'm going to copy and paste in the chat the list of real estate activities and then even that description on how to create a log if you would want, if you're trying to obtain the real estate professional status. Now, you don't have to be a realtor. You don't have to be a real estate broker or associate broker or anything like that. The professional status, the real estate professional status is dependent on activity and whether it's primary and material participation. Okay. Um, all right, back to you, Ralph.
Thank you very much, Leticia. Like great insights on that. Very detailed. Thank you. Okay, we'll go into market research. Market research involving apartments is a commercial type of property. It involves MSA or metropolitan statistical area involving a big or great region of containing a high degree of economic or social integration. Some stats to look into are population growth, median income growth, median housing growth, crime rates, 12-month job growth, and ethnic diversity. So look at these ranges, like 7 to 15%, 35, 50, crime below 400, 12-month job growth. Are you checking off the boxes when you're looking into a specific area? Or is it multi-ethnic as well? Time period, looking into 10 years, aside from the job growth. And some sources, yeah, you can look into like city data, Department of Numbers, Google will help you as well. And I would like to caveat and add that, yeah, go to the real source information data versus third party. It's better. And also look into people local to the market as well. There's better insights on data. And some data could change yearly, quarterly as well. To add, would you invest where you want to visit consistently? If you're not comfortable visiting or it looks too rough of a neighborhood, compare what you would like to do. Look at Google Maps as well. It might be dated, but it's a good indication of how the area looks. Does the neighborhood look good? Is the market in a flood zone or not? Also, some costs unique to the market to consider. Renovation supplies, insurance, taxes, vendors such as like involving construction, helping to renovate your property or maintaining your property. Here's some example from another presentation involving the Phoenix, Arizona MSA. It does check off the boxes where, okay, we're looking into strong economic performance, city growth, population, job diversification. The unique thing about Phoenix also in Arizona, it did have the Super Bowl. So just adding that number 4 to make it nice. But and then just going into your source data as well. Again, adding population growth, just seeing a nice trend over the 10 years. Also, growth through versus the national average. So compare your local market versus the national market as well. Rent trends, vacancy trends. How is the market you're looking into? Is it going up, down? And then just what is the year over year trend as well? Keep in mind, certain trends could change depending on the market. This is at 2022, 2023. So even in 1 year, trends could change as well. Job growth, performance, and a diversified workforce. So this is a nice graph. Okay, is your local market, how's your market on jobs and different areas of work? Do you have a lot of that? How's your unemployment? How is your new jobs during a specific time period as well? Okay, we'll go into finding the property. Here's some sites as well, or you can feel free to reach out to me. This is a long list, but you can start from sites from commercial, Crixie, LoopNet, residential, Redfin, Realtors, Zillow. There's way more sites as well. You can go through agents and brokers, off market, wholesaler, property manager, rental listings. You can actually drive for dollars. You will need to reach out to the person networking and your personal circle. Okay, important partners. I don't have a commission involving the listing of our fellow partners, but maybe free food, who knows? Uh, so involving CPA, enrolled agent, real estate broker, loan officer, developer, insurance. Feel free to reference or reach out to our fellow colleagues during the week that presented as well. Involving important partners, always be networking. You never know who you'll work with down the road. I know some colleagues, for example, 1 or 2 years, we just go to the same event or meetup. And then 2 years later, we end up potentially working or even working on certain projects. So it does take time. Look for qualities such as experience. Can they bring the capital? Do they bring the hustle to the team? And look into current team or local partner in your market that can be the boots on the ground. You never know. One example is, okay, I'm reviewing a property. It makes total sense, 100%. We can make an offer on this deal. But our local partner looked at it, okay, notice, okay, crime, location, not our cup of tea. So rely on both your or everyone's expertise, whether it's local or you're analyzing as well. You can also have other partners, asset manager, attorney, involving transactions and the syndication piece, property manager, leasing agent, virtual assistant, wholesaler, appraiser, inspector, title company, general contractor, cleaning company, pest control company, for example. So there's a good amount of partners. Additional qualities you would like to look into, are they accountable, trustworthy, respectable, consistent? Can they communicate timely? Do you all have a shared vision and mindset? That would be important qualities. Next is analyzing the property. This is my bread and butter. I like to analyze and underwrite properties. In the essence, is your property, does it make sense? Is the income greater than your expenses with profit for us and our potential investors? So here's a list of income and expenses. You have rent, other income, factor in vacancy, losses such as unpaid rent, concessions, loss to lease, or the difference that's not the market rent. Expenses, real estate taxes, insurance, utilities, maintenance, fees, payroll, other fees, legal and professional, advertising, general and admin, turnover, water and sewer, trash removal, additional reserves. And in your local market, you'll definitely have different costs as well. Okay, other additional items to consider. What is your potential loan and interest rate? Are you assuming, are you taking on a new loan? Down payment, repair, what is your budget? Do you have reserves? Closing costs, costs in relation to the location, specific to the property, um, tie in market research, and aspects of visiting the property. Like, what do you notice as well? Okay, if you have certain parts of the property that may need more renovation as well, versus what's stated when you're analyzing. Here's some formula and metrics. You can um, refer to places like Investopedia, but the top three that I like to use are the cash and cash return, um, the debt service coverage ratio, and the net operating income. It indicates, okay, how much you're paying for debt, how much is that part of your costs, what is your return. We try to target 8%, keep the debt at 1.25, and net operating income, which shows some nice bottom line numbers. After the analysis, this is an example of what you can see for 5 years, depending on what spreadsheet or underwriting tool you'll use. We like to look at, okay, what's the income minus expenses? So, have a mindset where, okay, you're either like a stealth jet fighter, you're looking at it at a super high view, like 40,000 feet, and then later you get to focus on what you need to do. Like, okay, what's the trend? What's cost that we uh, are increasing, or okay, is income increasing or decreasing as well? Yeah, do look at the trends, income, expenses, any outliers that stick out. This is yearly, but if you can go monthly, you look into costs, just see, okay, what's sticking out. Okay, next would be the rent analysis. It's a nice way to see, okay, what's your neighboring rents, help indicate whether you can increase or if you're able to get the property and it makes sense. So for example, we have our current line one property, it's 1865 for a 3-bedroom. In the market, you see rents up close to 2,000. So you can move up the rent about 200. So it shows your possibility of growth here. Also, you can reference through square footage. So we have $1.55 and $1.75 in the next property. So you do have some room there. Sales comparables, when you're buying and selling the property, you can use the property per unit or per square foot. So the purchase price here would be at 10 million, price per unit 257. So when you look at the 257 versus neighboring properties that are 350 and above, 350,000 and above, you can see the room for growth and potential when you're selling the property as well. Okay, going into the transactions. So the brief overview is having a letter of intent, purchase and sale agreement. You do due diligence, have an inspection period, title company communication, lending, and then closing. Okay. When you're making an offer, sometimes you'll be making an offer with multiple parties, and you go into the best and final where it's okay, based on your experience and the offer, you'll make it to the next group of competitors. So you could either be the chosen one or could be working with competing with other parties. Some key items in the letter of intent, yeah, you do have the property, purchase price, language, financing terms, deposit and closing date, and some due diligence items to look into. This is high overview. This could be a long list, but it could be the ownership and property details, tenant lease information, financial records. For example, you have a trailing 12 and other the rent roll, for example, expenses, bills, utilities, insurance, claims, improvements, and compliance. Okay, if you're getting serious, you go to the next round, or if you get accepted through the offer, purchase and sale agreement, similar items as in the LOI, and going further into like contingencies, other language, in case anything happens, conditions on both all parties, remedies if anything else happens, and further talking to the deposit or earnest money deposit as well. Involving title company communication, just my view is just have a great mindset where, okay, you're working with a concierge to help you get to the finish line. Be open and communicate clearly, just be timely, respectful as well, because you never know, you'll have potential leads and referrals after this as well. Involving lending, you do have different options, residential, commercial, creative. You can feel free to work with Aaron Hill on the lending piece. Involving residential, you do have like a FHA, you can do have VA, conventional. And then depending on size of the property, you can work with the mortgage broker. What's good about working with a mortgage broker is they do have so much access to different type of loans that you may not even know, or could be even effective for you versus, okay, you're going to like 5 to 10 different banks as well. You can go through just one person. Involving the commercial area, you can go to the spectrum where, okay, you can work with agencies or potentially the SBA as well. There is creative financing, seller financing, private lending through a private party or a company that does private lending, DSCR type of loans, hard money, and you can negotiate terms as well. Next would be managing the property. How will you manage the property, and recommend having systems in place, whether it's with a property management company, management team, work with your partners, or you'll self-manage. When you're managing the property, you should already have what you'll do even before day one. Have a scope of work, punch list, task list. Would highly recommend, if you're working with other parties or property management, look into weekly meetings. Okay, what are the action items that we need to get done, or who is accountable, when's the due date, what's the status. Also the expenditure or rehab and project tracking. Okay, what is the description and vendors we're working with? See a difference between, okay, what are we actually spending versus what we estimated? How long do we have left? When's the deadline? Is it completed? Ensure some urgency as well. And we're doing a fiduciary duty to all of ourselves, our investors, and our community, especially if you have parties investing in your property, and this, or if this is your own money, self-managing. Because at the end of the day, we do affect the community, our potential income. And yeah, you do want to have the community be happy with your property versus not managing it well. This is an example of managing a property through a business plan. You do want to have a business plan in place or have a great idea of what you'll be doing. This is an example. Okay, we're upgrading the units, having a certain budget, X budget. It's 16K per unit, so it's really wanting to upgrade this complex, for example. What we're doing to the interiors, exteriors, like cabinets, painting interior outside. Are we adding washer and dryers? Is it part of the community, or will the washer and dryer be in each unit, for example? And we want to increase net operating income and a nice community atmosphere. Having a utility system, add other services or amenities like internet, parking, having a pet park, other potential fees, upgrades, making the exterior nice through the playground, parking lot, for example, maybe adding storage units, etc. And then a new property management team, for example, could are they more effective? Can they help us reduce expenses in the long run and lower vacancies, keep retention as well. To summarize about Eagle Summit Equity and myself, we do provide value to you. We acquire and identify properties through underwriting. We professionally manage properties through partnerships and property managers. Or we can offer potential cash flow during the duration of the property and equity and appreciation on the sale or refinance. I just wanted to caveat, it could be depending on deal by deal. So the returns and potential could be different as well. We also actively provide passive opportunities through going through a business plan, through the apartment niche. And we specialize in attaining real estate for passive income for you. You don't have to take extra tasks for your hard-earned money. And we have more opportunities for you to travel, time, and freedom for yourself and your family. So looking forward to connect with you as well. As a thank you for your time and being part of the presentation, we have some free gifts, free tools for passive investing guide. Also had the honor to interview Leticia as well for a previous podcast. So thank you for your time, and let's see. I'll keep this up for a while, and the next page will just be my contact. And Leticia was nice to give all the links as well for your convenience. Thank you again, Leticia. I'll hand this presentation back to you.
Thank you. I'm gonna, instead of pinning myself back up, I'm gonna leave this slide up so if people are scanning the QR code, they're able to get that or at least screenshot it for later. And then, Raphael, I didn't get a chance to introduce you at the beginning. So Raphael and I actually have known each other for over 20 years. We went to high school together in Hawaii, and we actually went to church together at Our Lady of the Mount growing up. We went to the same church. We grew up from Kalihi. If anybody is from Hawaii, they know that Kalihi has just a really bad, like rough reputation. And so it's just an honor and a blessing to know Raphael from Kalihi. And until now, we're professionals. There's so many people that say bad things about the district we're from, like nothing good comes out of Kalihi or Farrington High. But we both know that that's not true. And there's so many other professionals that have come out of that high school and out of that
Definitely.
district. So it's just nice to see another fellow alumni breaking stereotypes and doing amazing in their area of expertise. And let's see. So I have dropped Raphael's information in the chat. And he really took us through like the gamut of what it's like to actually look for an apartment complex, the different types that are out there, the market research that you should do. I've worked in property management for a little over 2 years. And so the market research is a key piece because you want to make sure that especially when you're doing an apartment complex, since there's so many doors, you have to make sure that it's located in a place where there are jobs and people that can support the market rent, right? And because you have so many doors to rent out, it's like it has to be in a location where people want to rent and live and where there's jobs nearby, where there's grocery stores and good schools nearby. So that market research is a key piece. And you're right, when you're an investor and you're buying properties in another state, it still makes sense to spend the money if there's nobody local on the ground to go check out that investment property. It makes sense for you to go and check it out for yourself, because there's so many things. Just from working in property management myself, and I used to do virtual tours and stage homes and take pictures. There's still a lot of things you can't tell from the pictures. You actually have to go and walk the property, go during the day, go at night, go at midnight, and see if, do you get the heebie-jeebies? Do you still feel good? Do you feel safe at night? I mean, there's different things that you should do just to make sure, because real estate is such a big purchase as far as the amount of money that's involved or the amount of money that you're going to borrow for it. You want to make sure that it's a solid purchase. Now, Raphael, a question that I had, because you did go over like you could finance this different ways. You could take out a loan. You could do this with partners. And so, for what you've done in your experience, how have you been able to make this work when you first got into apartment complex investing?
Sure. Great question. I started, I'll go from day one. I started as a passive investor, um, through apartment complex investing as a limited partner. So I could use, different retirement funds such as a self-directed IRA and a solo 401k, as a passive investor, but involving financing, been part of different deals where, okay, if we're a passive investor, the main sponsor will handle all the financing, and then you just contribute your funds. Or if you're going on the active side, you go dealing with, um, just had a recent triplex we're dealing with where, okay, it will be a mix of seller financing where, it's to be high level, it's a stack of a private lending company. The seller was okay for 15% financing on their side, and then we come in with 10% down payment, for example. So it could be different terms, or different ways. Other properties use agency financing as well. So it can go, depending on the size of the property, the how you negotiate the property, and uh, with the seller as well, and the type of property and finance. Or another deal is we assume the loan from the seller and then keep the current interest rate as well. There would be a potential down payment involved, but you could also assume uh, the loan from the seller.
Okay. And then with Eagle Summit Equity, you're able to help source for other investors that are looking to partner with someone to purchase a property. Is that correct?
Yes, correct.
Yeah, so if you're not able to source people within your own circle of influence that might want to go in with you, then that's something that Eagle Summit Equity can do, is pair you up with other people. Now, when you get paired, so when you're looking for someone in a partner, is there like an application process? Do you have to do a credit check to make sure that you have credit? Do you have to turn over documents to show what cash that you have available in order to give the funds? Like, how do you prove that you would be a worthy partner? And then how do you vet other people to make sure that you're going into a deal with other people that are reliable and that won't back out on you? Like, it won't be a bust as far as investing with others.
That's a great question. My journey, I've been in this space for at least 3 years, but consider this as not overnight. You would definitely need to create your relationships and build your relationships in the long term. I'm part of two accountability groups, so you still need to vet who you're working with. Um, Look into, okay, what experience do they have in the field, um, or in the niche. Also, who are their potential mentors if they had mentors as well, or are you in the similar circles, similar groups? Involving application, you can make it very formal or informal. However, I would caveat that once you secure the property, everything will be in writing as well. You do need to have definitely a very defined and shared vision when seeking or working with partners as well, involving what people can bring to the table experience? Can they have potential capital as well? Can they bring they're really great and getting things done? So just having a mix of who can complement you as well. I hope that answers that.
It does. And then when you're trying to, so you took us from like very beginning when you're researching and looking for a property all the way to the letter of intent, getting the financing and then closing it out. And then once it's yours, then you can start with the property management side or outsource that out to a local company. But as far as the market research, how long would you say that typically should take? How long should you expect the entire process to take? The markets research portion and then the financing and like agreement and signing portion to make the property yours for yours and your partners.
Oh, great question. It could be really quick or it could be short, depending on if you already have resources and data in place. So the market research, you can do all that in a few hours in a day if you want to, or you can space it out. You do have to refine or look into um, the different aspects of like cost local to that specific market. So it may take time to finding specific information. So it's great to work with the local partners, or if you have a great relationship with either the brokers or property managers in that area. Next would be the transaction involving being involved with different transactions. It could the timeline could be extended, it could be smooth depending on how small or big of a property you're looking at. So if you're looking at small properties, I would caveat that everybody's experience is different. You have a lot of things during negotiation and closing the deal and financing. You do have like a lot of documents and a lot of negotiation or clarification involved as well. So I would give like a nice 1 year, 3 months to 1 year duration, because you could even extend the closing just because you might have, okay, we uncovered something that the seller says, okay, it's all good, but when you do the due diligence or inspection period, okay, something is totally not working or not renovated. So, okay, will the seller give a credit, for example, or will the property be at a lower selling price, or it could be because of financing, okay, or closing where, okay, do we have enough funds to bring to the closing table, whether it's investment or our own, or if okay, could be holidays or um, other aspects that we can't control.
Yeah, that makes total sense. And then something too that I wanted to add in as far as like the financial statement. Since I'm an accountant, I'm a CPA, that's so important is reviewing the financial statements on the apartment complex to see if they're making money, if they're making money currently, if they've made money historically, if they've had a bad year, is there another good year that has, then, now the market is recovering and what have you. And then even the rent rolls. I know that when we would help property new investors for the property management company I worked for, we would pull rent rolls and the rent rolls just shows who's paying, how much money they're paying a month and what have you. But we would also ask for copies of leases just to see, okay, if a apartment complex is fully occupied, when do the leases end, right? Because you don't want to purchase a property and then you have like half the people move out. Like that would be terrible because you were expecting a cash flow and now the cash flow is cut in half. And so looking at those really inspecting the documents to make sure that there is cash flow and it is substantiated is really important. And then number one, if you don't know how to read financial statements, that's something that you should definitely learn to do, so that you can make sure that you're not getting a haircut you didn't want and you can't afford, right? It's like you have to know that the numbers make sense and that they're real and that there's underlying documentation to make sure that you're buying a property that is a good investment and will give you back money, the money that you were looking to get a return from, that you're spending on it. Let's
totally
see.
agree, Leticia. Can I add to that as well? Yeah, feel free to have a second pair of eyes. Feel free to take time to look at it. Okay, if you're the one analyzing the property to see if it makes sense, you can just put all the data there and then come back to it at another time with fresh eyes. And then feel free to just clarify, okay, if this doesn't make sense, please either reach out to your broker or whoever provided the property documents, numbers for analysis. Okay, why is this number when you know, okay, it's only X number in this market. So just feel free to be open to clarify and have peer review as well.
Yeah, very nice. Or even look into the property taxes, like what would you pay in property taxes too on top of everything? Yeah,
Yes.
there's so many other expenses to look into to make sure that you truly are going to make a profit once you're the new owner of that property. Let's see. Now, I've asked a few questions. Are there any questions from the audience? Does anybody have any questions for either Raphael or myself? Dum, 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 dum. Okay, so Kanisha's good. Paul and Marlon, are you guys good?
I'll
Okay.
keep myself open if there's any questions that anybody thinks of even after the presentation. Feel free to reach out to me as well.
Yes, and thank you guys for attending. Thank you for